The market did not crash because of the headline you saw. It crashed because of something you were never shown. A silent lever got pulled, and that lever made every dip feel like a trapdoor. If you panicked, it wasn't your fault. The way the fall happened was designed to push you to the edge. Here's the part nobody tells you. The people who did well today didn't read the news faster. They watched a dial you've probably never heard of. When it flicks from calm to chaos, your feed lights up red a few hours later. By then, it's already too late to ask what just happened. I spent the morning chasing footprints. Earnings weren't shocking. Rates barely moved. The narrative on your screen sounded convincing, but it was a decoy. The real cause was buried in the market's plumbing, working quietly while everyone argued about headlines. If you learn to see that plumbing, you stop being the last one to know, and you start acting like the tiny group that quietly wins on days like this. Today, that group saw it before you did, and by the end of this, you'll understand exactly why. There's a device in this market. You won't see it in your app, but it decides whether a dip is buyable or a hole with no bottom. I call it the invisible switch. When it's on, the market absorbs shocks. When it's off, the same shock explodes into a slide that feels personal, urgent, unfair. Today, the switch flipped, and the crash you felt this afternoon actually began hours earlier, in a place where bets are insured and the insurers quietly change sides. Here, that's what that looks like from your couch. You open your phone, the numbers are red, you hear the anchor say it's inflation or a policy comment. But if the switch is off, the bids you expect to catch you are gone, and every sell order slices a little deeper than it should. That's why a calm morning can turn into a freefall after lunch, like someone drained the pool while you were mid-air. Why does this matter now? Because the switch can stay off for days. If you treat tomorrow like any other day, you risk walking into the same vacuum with the same plan. And that's how a bad day turns into a bad month. The outcome is predictable when you know where to look, but we're not there yet. Early today, before most people finished coffee, a whisper moved through the places where risk is insured. Not a headline, a posture change. The crowd heard nothing. The pros heard a rule change and shifted. By lunchtime, you felt the aftershock. Here's the part that stings. The majority always chases the story they're given. The minority that wins watches for a pattern you can't fit into a banner. When that pattern appears, they stop trying to be heroes. They get out of the way or they wait with a plan. On days like this, the market is not a democracy. The biggest sellers aren't people deciding anything. They're machines doing math, responding to that whisper like smoke alarms. One input changes and they must sell, not want to, must. That's why the fall felt mechanical, like every bounce was allowed only a breath before the next shove down. You can feel that texture in your bones. It is not panic, it is procedure. And here's the urgency. The same whisper can flip back as quickly as it flipped off. If your strategy depends on guessing moods, you're gambling. If it depends on spotting the switch, you're finally playing the same game. But what is the switch exactly? Not yet. I started the day like you did, checked the headline, felt that gut clench. Then I went looking for footprints. First, I looked at the usual culprits: earnings misses, policy chatter, oil spikes, but nothing there explained the rhythm of the fall. The rhythm matters. Panic has a messy beat. Today had a drum line. Small bounce, sharp shove. Small bounce, sharper shove. That's not fear, that's choreography. Imagine someone who set up a simple portfolio 20 years ago and never looked. Through every scare, their patience paid because the market's shock absorbers kept working most days. But on days like this, those absorbers failed. It's not because stocks suddenly became worthless. It's because the people paid to steady the ride had to take their hands off the wheel. That is the footprint. Spreads widen. Bids step back. Volume surges at the worst moments because forced sellers always wait for the same green blip, and when it hits, they all rush the same narrow door. But here's the part nobody talks about. The door gets narrow on a schedule. Certain afternoons, certain weeks, the plumbing is thinner. The same dollar of selling falls harder. If you know those windows, a red day looks less like a horror movie and more like physics. And once you see physics, you stop shouting at the screen and start planning your next move. Planning how, though? Picture a public pool at noon, families everywhere. Lifeguards calm. A kid cannonballs, big splash, everyone laughs, the water settles. That's a normal dip. Now same cannonball, but someone quietly pulled the plug. The water line drops while the kid is mid-air. They hit hard, not because they jumped higher, but because there wasn't enough water left to catch them. That's what today felt like. The splash looked big because the pool was low. Why was the pool low? Partly because passive money, the monthly tide that buys no matter what, was between waves. Partly because the insurers of market bets had taken on so much exposure to quiet markets that a small move forced them to sell just to survive the math. Partly because certain funds that balance risk by rules saw volatility rise and were required to cut. None of these actors met in a room. They just followed rules. Your portfolio met their rules. Here's the part that connects to your wallet. If you sold in the hole today, you gave your shares to rule followers who had to buy later. If you held with no plan, you sat in pain. If you had dry powder and patience, you were the one getting paid for other people's rules. But how could you have known the pool was low before the splash? The answer is the switch. The invisible switch is this: the moment when the people who insure market bets flip from calming moves to amplifying them. They hedge with shares. When markets are quiet, their hedges cushion dips. But when a move grows and their formulas cross a line, they must sell into weakness to protect themselves. That forces bids to vanish. At the same time, passive money pauses, and funds that manage risk by fixed rules must cut exposure. Together, that turns a headline into a mechanical slide. You can spot this before you feel it. Watch for three tells. 1. The days around big bet expirations often thin the pool. Treat midday bounces with skepticism. 2. When mornings open soft and can't reclaim the first slide, stop trying to be a hero in the first hour. Wait for late day balance. 3. If spreads widen and bounces get shorter, respect the machine, stage buys with limit orders, and keep a cash slice you can live with. Do not use borrowed money when the switch is off. That's why it crashed today. Not because the story changed, but because the switch flipped and the plumbing turned a ripple into a riptide. Now you know what to watch. If this made the red day make sense, you're already ahead of the crowd that argues with headlines. Subscribe and you'll keep catching these whispers before they become shouts. Tap like so this reaches someone who sold at the worst minute today. Next, watch the episode where I map the exact calendar windows when the pool quietly drains. The dates almost nobody marks, but the pros never miss. Because once you see the switch, you stop fearing the fall and start preparing for the rebound. I'll see you there.